let's go straight to Stuart in London because he's waiting there. He's been waiting there for 2 minutes. Let's talk about South Africa's most profitable retailer. The interest rate environment, of course, is very important in South Africa and the world, and it affects retailers. So Stuart Theobald, the chairman of Intellidex, is on the line now from London. Stuart, the retail market in South Africa is fascinating. We've got companies like Truworths, for example, that are credit retailers, companies like Mr. Price, which are cash retailers. But let's break it down. Who makes the most money?
Well, it all depends on how you define making money. There are some that make very big margins. There are some that do very big volumes. And which kind of strategy a retailer is pursuing really defines what kind of numbers you're going to see. So in the South African market, we generally think about the cash retailers, so big grocers, firms like Pick n Pay, ShopRite, and then you think of the credit retailers. You mentioned Truworths. Other big ones are like Lewis Stores and JD Group, who sell a lot of their furniture on credit. And when you look at the numbers, you see much bigger margins of those in those kinds of operations, margins like 20–30%, whereas the big cash retailers' margins become much smaller, sort of 6–7% down to 1–2%.
When you look at the valuations of the stocks on the JSE, for a couple of years now, people come onto this show and every other show and say, no, they're far too rich for us, and yet the market, after a few brief wobbles, keeps on going again. I mean, I saw a couple of nights ago that a couple of retailers were in the top 5 performers of the all-share top 40 shares. They're so resilient, and that sort of tells us that the retailing industry in South Africa is very well developed.
Yeah, it's very interesting that, Lindsay, and I'm sure some of your guests who've been negative on the kind of ratings you see in retail stocks, some of these are trading at close to 30 PEs. And we've actually seen South African fund managers being quite bearish, and really what's driven a lot of those ratings is foreign interest in South African retailers, where foreign analysts will look at our market and compare it to others in the developing world, and we apparently come out quite favorably, even though for a domestic fund manager looking at retail compared to other stocks like, say, banking, retail looks a bit expensive. So there's just a different way of analyzing, and it leads to these different outcomes, and generally the local investors have been more bearish. Do those sort of ratings, are they justified? Again, looking at credit versus cash retailers tells you quite a different story. The credit retailers are not only about selling volumes of products, it's also about interest rates and how the broader economy performs in order for them to manage the large credit books that they have. I mean, a business like Lewis Stores actually makes more of its revenue from selling financial services than it does out of selling furniture and electronics and the rest of it. So their numbers can be driven very substantially about the broader economy, whereas the cash retailers tend to be more resilient. They're selling basic products that don't vary very much. We're always going to need to eat no matter what the economy is doing. So they tend to attract a kind of risk averse and do better when markets are feeling a little bit nervous.
Yeah, there's so much to take in when you look at the retail sector. You've got apparel, you've got food, you've got furniture, you've got building materials, you've got credit versus cash. You've also got to take into account that the foreign holdings, because if there is some sort of wobble on the international markets, then they press the South African retailing button on the sell side and they're indiscriminate. It's not maybe your position at Intellidex to tell us what to buy, but tell us what to buy.
Look, the right strategy is always to go for diversification and don't concentrate too many eggs in one basket. Retailers offer good, cash retailers particularly are a good defensive stock to be in. They're not too vulnerable to the broader market cycles. Even if you do get trouble in foreign markets, there's enough South African support underpinning it to keep those prices at reasonable levels. The more volatile, the more risky are going to be your credit retailers, businesses like Lewis, Truworths, and so on. Even though they were actually restructuring themselves to try and get themselves out of exposure to more volatile ends and out of exposure to large credit books that are vulnerable to bad debts. But inevitably, those kinds of apparel companies are more vulnerable to the consumer cycle. When consumers are under pressure, you're going to see their sales under pressure as well as the performance of their lending book. So definitely a riskier prospect. But if the economy does well, that's where you want to be. You'll see sales pick up and you'll see better performance on the credit side. So if you're an optimist, you want to expose yourself to that kind of risk. But if you're someone who wants to be cautious, much better to be in the credit retailers.